Are you aware of the upcoming game-changing strategy that is taking shape on the global financial stage? This is not your typical financial story, as it involves some unexpected players, the BRICS. You may have heard of BRICS, which stands for Brazil, Russia, India, China, and South Africa. They are not planning to bring down the US dollar. They are unveiling a unique gold strategy that could potentially reshape the financial world. In this context, we will delve into the insights shared by Jim Rickards, a financial expert, regarding BRICS' surprising approach to gold. So, let's begin and discover what is really happening on the economic chessboard. Before we begin, we have a bonus stock pick in this video that could help you earn a lot of money. This stock has the potential to change the game completely. Don't miss out on this golden opportunity, so make sure you watch until the end.
This is not the petro yuan. This is not the petro ruble. This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world. It's not any of those things, but that's what everyone's running around on websites or whatever shouting about. It's none of those things. In fact, quite the opposite. And this is where the Russian mentality comes in. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring one brick equal to a weight of gold. Again, weight's the key. Value of the brick is not determined with reference to any other currency. It's determined with reference to gold by weight of gold. Now, I don't know the weight, they'll pick one, but again, it doesn't matter because it's not even, it's math, it's logic. And by the way, now we're back to Aristotle's transitive law. This is the key. This unlocks the whole thing because Aristotle said, if A equals B equals C, then A equals C. The B can drop out. It's not even arithmetic. It's logic. It's called the transitive law. I'm certain that Aristotle invented it. If any Greek scholars know an earlier source, let me know. So what the BRICS have done is they have dodged the biggest bullet, the thing that caused Bretton Woods ultimately to fail, the thing that potentially stands in the way of all this. They've defined their currency by weight of gold. Now, a weight of gold has a dollar value, right? So A equals B equals C. One brick equals one, could be an ounce or a kilo, it doesn't matter. Call it an ounce. One brick equals 1 ounce of gold equals today, 1970, okay? Well, through the transitive law, drop out the B and one brick equals 1970, $1,970. But that's constant. I mean, that logic works for a moment in time, but it's not fixed because the price of gold is going to fluctuate daily or minute by minute, right? So what's going to happen is the dollar gold, call it exchange rate, the dollar price of gold. So the LBMA, the COMEX, the London Metals Exchange, JP Morgan unallocated forward contracts, the whole huge gold market in dollars is still going to exist. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring one brick equal to a weight of gold. Again, weight's the key. They just let the dollar gold market go wherever it goes, and the brick is worth an ounce or whatever, kilo, whatever. And the dollar equivalent under the transitive law changes, but they're not pegged to the dollar. They're not fighting that fight. So this, I analogize this, it's like you're in your house, in the backyard, your landscaper is like digging trenches and putting in plants and sweating and doing all this work. And you're sitting there with a glass of iced tea enjoying the view. In other words, the BRICS get to free ride on the dollar gold system. And they want that system. They don't want it to go away because they get the benefit of a gold value. Now think of what the BRICS don't have to do in this scenario. They don't have to buy gold. They don't even have to own gold. They do, but no one in the world has enough gold to back a currency. This currency, the brick, will not be redeemable into gold. Now, maybe there's a dealer somewhere who will take it. That's between you and the dealer. But it's not like you're going to be able to march down to the People's Bank of China with a pile of bricks and say, give me the gold. They're not going to do it. So it's not redeemable. They're not going to make a market. They're not going to maintain a value because they don't have to, because it's by weight. They just get to sit back and piggyback on the dollar gold system and let the dollar do all the dirty work
Jim Rickards emphasizes the Federal Reserve's pivotal role as the ultimate buyer of treasuries. In contrast, the U.S. banking system, which has changed significantly since the 1950s when large banks held substantial treasuries, serves as an intermediate buyer. The U.S. government wields influence over these banks and is likely to purchase bonds when needed, serving as a buffer before the Federal Reserve expands its balance sheet. This strategy becomes especially important during a reset, as the appeal of buying perceived safe treasuries outweighs making loans. Additionally, Rickards discusses China's approach, where commercial banks within the country are actively selling U.S. dollars to acquire more yuan. Now, let's listen back and hear more about what he has to say.
The first one is the Fed the ultimate buyer of last resort of treasuries? Yes. But there's an intermediate buyer, which is the U.S. banking system. In the 1950s, a typical large U.S. bank balance sheet was 40% treasuries. That was normal. That wasn't like hoarding. Today, it's about 5 to 7%. Wow. So I think you'll get a phone call to Jamie Dimon and I forget all the other CEOs, Jane Meyer and the lady at Citi. They'll call them first to say, people got to buy bonds. And of course, they're all under the thumb of the U.S. government, and they will. So you might have a pretty good cushion of bond buyers before you have to turn to the Fed and expand the Fed balance sheet. Now, that doesn't
especially if it's a recession, because they're not going to want to make loans with that money. They'd rather buy treasuries that are perceived to be safe, probably.
Correct, especially with positive carry and lever at 10 to 1 under Basel, you can make very good returns on equity. So, so you do have a large pool of intermediate buyers before you get to the Fed. It doesn't really solve the problem. It just passes it around the banking system. By the way, the Chinese are doing something very similar right now. Everyone's like, why hasn't the People's Bank of China sold more dollars? Well, it's because they're making the banks do it. The commercial banks are selling the dollars and propping up the yuan. And we can see something similar in the United States. So that's one. I just kind of pencil in the commercial banking system, at least the big banks, as potential buyers of not quite last resort, as a way to put it. But the other thing, the BRICS, what they've done, this is part of the brilliance, they've opted out of the exchange market. They're like, because normally if the dollar is getting weaker, you're getting stronger. That's bad for exports. It's bad for export-related jobs, et cetera. And it's currency wars. That was my first book, Currency Wars. But by defining their currency by weight of gold, not dollar amount, but by weight of gold, they're out of the foreign exchange market. Yeah, so, and they can just sit back and watch the show. We haven't learned about uncertainty because we already know about uncertainty. We all understand that we're living in an uncertain world and we have to make allowance for that. So we didn't learn that. We already knew that. I said, well, what is new is the tempo of shocks is accelerating. There are shocks, go back to the panic of 1837 or 1857 or 1898. You know all of them. I've lived through enough of them. I'm kind of a magnet for trouble. But there's no end to financial panics. But what's different about this is that we may be looking at a tempo that's a lot faster. It's not every 7 years or every 10 years anymore. Between the U.S. is losing the war in Ukraine badly. You might even see Poland come in and bite off the western half of Ukraine, former Ukraine, up to Lviv, and Russia take the bottom 1/3, including the entire coastline to Odessa, and leave a little landlocked rump state around Kiev, maybe. So there's no way to cover this stuff up. The New York Times and the Washington Post, I read them the same way I read Pravda during the Cold War. It's all lies, but they're valuable lies because it's good to know what the other guy's lying about.
Exactly.
Yeah. If he's lying, it's like you must have a reason for that. It must be important to you. So there's intelligence value in lies, and that's why I read the Times and the Post.
Now, as we navigate these uncertain economic waters, it's crucial for you to consider diversifying your investments wisely. As Jim Rickards points out, one smart avenue for diversification lies in minerals and resources. In times like these, they can provide stability and growth potential. That's where our today's sponsor, Kinex Mines, ticker CLLXF, comes into play. They're a trusted source for investing in valuable resources, particularly minerals. With their expertise and track record, they can be your partner in making strategic investments that stand the test of time. Kinex Mines has no debt, which means that it has a strong balance sheet and can fund its exploration activities without diluting its shareholders. This also gives it more flexibility and bargaining power in case it wants to partner with other companies or sell some of its assets. Kinex Mines has a team of award-winning, Hall of Fame geologists who have decades of experience and expertise in finding and developing world-class deposits. They know how to identify and target the best prospects and how to optimize the drilling programs to maximize the value of each hole. Kinex Mines operates in some of Canada's safest and most mining-friendly jurisdictions, where there is a low risk of government or community interference. These regions rely on mining for jobs and taxes, so they welcome and support responsible exploration and development activities. This stock has major leverage for rising base metals prices, as its projects are mineralized with gold, silver, zinc, lead, and copper. These metals are in high demand for various industrial and technological applications, especially as the world moves to an inflationary environment. China is the biggest consumer of these metals, especially zinc, used for galvanizing steel, and copper, used for wiring and electronics. As China's economy grows and its middle class expands, the demand for these metals will only increase. Lastly, Kinex Mines has made a major silver discovery at its Rainbow project, which is located between two other world-class gold-silver-copper deposits, the Alchemist Discovery and the Nash Creek deposit. The Rainbow project is a volcanic location where these metals came from a massive underground volcanic eruption. Kinex Mines believes this project is the source of these other deposits and could be even bigger and richer than them. They are currently drilling this project and expect to announce drilling results very soon. So there you have it. These are some of the reasons why Kinex Mines is a great investment opportunity for anyone who wants to make big profits in the mining sector. This is a company that has a lot going for it: massive insider ownership, great momentum, no debt, award-winning geologists, safe jurisdictions, major leverage for rising base metals prices, and a major silver discovery. But don't take my word for it. Do your own research and see for yourself why Kinex Mines is a stock you don't want to miss. If you want to know if a company like Kinex Mines is a smart investment, you should understand the concept of a cash runway. It's like the money a company has in its pocket to keep things running without any new income. The longer the runway, the more financially stable the company tends to be. So, as of March 2023, Kinex Mines had cash on hand amounting to $6.7 million, and the good news is they had minimal debt to worry about. But here's where it gets interesting. You need to look at the cash burn rate, which is how fast the company spends its cash. In this case, Kinex's cash burn increased by 15% over the past year. That means they're investing more in the future, which can be good but shortens the cash runway. Now, here's why this matters to you as an investor. If the cash runway gets too short, Kinex might need to raise more cash by borrowing money or selling more shares. This can dilute the value of existing shares and impact shareholders like you. So, while Kinex Mines has a healthy cash position now, keeping an eye on their cash burn and potential future capital raises is crucial. It's like watching your savings account and ensuring you have enough for the long run. So before we end this video, remember to keep an eye on what's happening in the world of finance. Also, take a moment to think about what Jim Rickards shared with you. Now, when it comes to your investments, consider mixing things up a bit. Kinex Mines might just be the ticket. They've got a good track record, and they're onto something big with those high-grade copper resources and their recent discoveries. So, does all of this make you think about where you're putting your money? Let us know in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about Jim Rickards' thoughts on the global economy, I highly recommend watching this amazing video. Just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.